Today I'm going to be updating you about my stock account. Today my stock account has made a loss of $865. Stocks closed lower on Thursday, dragging the technology stocks lower. And what if you the US government debt ceiling battle? So let's take a look at my account. Today in my account has gained a total gain of 882.01 or 1.22%. Right now the net asset of my account is $73,776.83. Today all of my stocks showed a sign except for United Natural Gas, which come from a decrease in the recent days. It dropped to 6.96 often in the post-market. UVXY rose 3.19% as stocks closed lower. SQQQ rose for 2.46%. As for the market today, Dow Jones Industrial Average closed down 0.33%, Nasdaq Composite closed down 0.8%, and the S&P 500 closed down 0.6%. Telecom closed down 2.36%, and the auto manufacturers, especially Tesla, closed down more than 5%. The diagnostics and research closed down 2.12%, and the internet retail closed more than 1%. Traders viewed a new round of mixed corporate results. Tesla's disappointing results dragged down technology stocks lower. The latest economic data suggests that the U.S. economy is shrinking. A hawkish Fed official had backed another rate rise. Treasury yields continue to fall after the jobless claims data. The 2-year and 5-year Treasury yields fell as much as 7.5 basis points early Thursday, while the 10-year yield fell to a new low of around 3.53%. Tesla closed down 9.75% as it reported a first quarter net profit of $2.513 billion, down 24% from a year earlier. Tesla has repeatedly cut car prices so far this year, making investors worry that its profit margins are under pressure. American Express's results provide new clues to the Wall Street consumer health. The company reported lower than expected first quarter profit and higher than expected credit loss reserves. So far, 15% of all of S&P 500 companies have reported financial results. While investors' attention was largely focused on their quarterly results, Bank of America Wealth Management Senior Investment Director William Northey said, the companies that reported earnings will not dominate the ups and downs of the market. So far, U.S. stocks' results have been mixed, and individual stocks have reacted based on specific earnings and expectations, but the market has not been affected by those results. Fed officials spoke closely watched. Fed officials speaking on Thursday, including the Fed Governor Christopher Waller, Atlanta Fed President Raphael Bostic, and the Cleveland Fed President Loretta Mester. In a speech Thursday, Cleveland Fed President Mester hinted support for a second rate hike to calm inflation, while citing the need to focus on the near-term banking pressures that could curb inflation and that could curb credit and suppress the economy. Mester said, I expect the monetary policy to move further into restricted zones this year, the federal funds rate rising above 5% and the actual federal funds rate remaining in the positive zone for some time. On Wednesday, New York Fed President John Williams said pressure on the U.S. banking sector could lead to a credit squeeze. U.S. inflation remains too high and the central bank needs to maintain tight monetary policy. The U.S. economy has stalled in recent weeks. Employment and inflation has slowed, and credit channels have tightened after recent pressure in the banking sector, according to the Federal Reserve's Beige Book survey released on Wednesday. Analysts believe that the Beige Book survey raised the possibility that the Fed policymakers will pause after expecting a May rate hike. Traders continue to bet on a May rate hike. Given the pricing of future contracts, the Fed is widely expected to raise rates by another 25 basis points at its May 2 to 3 for second to third meeting. CE's Fed Watch tool showed an 83% estimate of a 25 basis point chance of a rate hike at its May meeting. Moreha Vemane, senior multi-asset strategist at State Street, Global said. Inflation will not disappear on its own. Whether the Fed has enough determination to undermine the economy to reduce inflation remains a question, and it looks like they still have enough determination. On the economic data front on Thursday, the Labor Department reported that initial claims for unemployment benefits in the week ended April 15th were 245,000, compared with 240,000 expected and 239,000 previously. For the week ended April 8th, continued employment benefits were 1.86 million versus 1.82 million expected and 1.81 million previously. The continued rise in people receiving unemployment benefits is the latest sign that the labor market is starting to lose momentum, analysts said. Another data shows that the Philadelphia Fed's manufacturing index for April was negative 31.3, the lowest since May 2020, from a negative 19.2 expected and negative 23.2 expected last. Philadelphia Fed Manufacturing Employment Index was negative 0.2%, last negative 10.3%. The Philadelphia Fed Manufacturing Price Payment Index was 8.2 in April, up from 23.5 last month. Philadelphia Fed Manufacturing News Orders Index for April was negative 22.7, last negative 28.2. Data from the National Association of Realtors shows Thursday that the median sales prices for existing homes in March was $375,000, up 0.9% from a year earlier, the biggest drop since 2012. Talks between the Biden administration and the Republican-controlled House of Representatives on debt ceilings have stalled after the federal debt ceiling reached $31.4 trillion in January. On April 19th, the White House again called on Congress to raise the debt ceiling to avoid historic default. On the same day, Speaker of the House John McCarthy unveiled a bill designed to raise the debt ceiling by $1.5 trillion, or extend it until the end of March next year, whichever comes first. In treacherous global economy, the divergence in the U.S. government's debt ceiling has again drawn attention. Interestingly, while Democrats and the Republicans have repeatedly faced off the debt ceiling, the focus itself is not on whether to raise the debt ceiling. On the contrary, the main reason why the two parties have repeatedly failed to agree is that they both insist on linking the debt ceiling increases to the size and the interests of their own parties. In other words, the current debt ceiling issue has become a bargaining chip for American politicians to reach or block certain policies. In fact, the debt problem has always been the source of Democrats over the U.S. government and has a long history. Since 1976, there have been more than 20 government lockouts since the debt ceiling peaked, including nearly 800,000 non-core employees suspended during the 2013 Obama administration and the longest shutdown in history during the Trump administration in December 2018. At the root, the White House call for the debt ceiling is the imbalance between GDP growth and debt growth. Since taking office, the Biden administration has introduced a series of huge support programs, including the bailout bill, infrastructure bill, and chip and technology bill, which have driven a surge in government spending. But GDP growth has not kept pace. Quarterly data shows that the December 2022 quarterly GDP growth was only 0.88% in December 2022. That is why, on March 10th, U.S. Treasury Secretary Janet Yellen, before the House of Representatives, strongly called for a failure to raise the government debt ceiling that could be an inevitable economic disaster. Raising the government debt ceiling to resolve the crisis has been repeated in American history. Since December 2013, the legal debt ceiling has been raised 9 times, starting at $16.7 trillion in 2013 and nearly doubling so far. Over the same period, the share of outstanding U.S. Treasury bonds in GDP also soared from 99.38% in December 2013 to 121.47% in December 2022. By 2052, according to the Budget Office, public government debt will reach 185% of GDP, and the net interest payment on government debt to 7.2% of GDP. As we all know, for an economy, keeping a balance between debt and income is an important basis for ensuring that no systemic economic crisis occurs. But in the real economic operation, it is actually difficult for the two to achieve simultaneous growth. If the debt grows too fast, it is easily to induce the payment risk and then breeds a financial crisis. So a basic theoretical consensus is that if a country's debt rises by more than 30% in 5 years, a default is likely to follow. If that rule continues in the future, the possibility of a U.S. debt crisis is imminent. That is why the recent reduction in U.S. Treasury bonds seems to be a tacit understanding and consensus in global markets. Treasury's revenue data further fears about the U.S. debt default. In the Treasury statistical caliber, X day is a technical term referring to the date when Treasury may have a technical default in the exhaustion of unconventional measures and TGA accounts cash. Just after the tax filing date on April 18, 2022. The Treasury's cash reserves increased just about $100 billion, while below its forecast of $150 billion. But it's also worth noting that the recent movement of the U.S. economy are going on, according to the Beige Book released on April 19, 2023. 3 of the 12 regions of the Fed, excluding New York, Dallas, and 3, saw slight growth. Overall, the judgment and that the crisis may not be justified. The main reason is that, first of all, the dollar as a global currency can default indirectly through the depreciation of dollar and inflation. Secondly, the Fed can also take advantage of the dollar to shift the crisis to developing and emerging economies by raising interest rates and shrinking its balance sheet. Third, the United States can use its position as the world's largest economy to generate excess returns through extraordinary means such as a trade war. Historically, this is common in the U.S. That's all I have for today. Thank you for listening. Don't forget to subscribe and like. See you next episode.